All right, everybody, welcome to our third quarterly call of 2026. Glad to have everyone with us today. Just as a reminder, we'll have a question and answer at the end of the call. So if questions come up, please feel free to use the question and answer feature at the top of the toolbar there in your video, and we'll get to those at the end. So before we begin, we must remind everyone that O'Keefe Stevens Advisory quarterly call does not provide investment, tax, or legal advice. The information presented here is not specific to anyone's personal circumstances. The presentation is for general information and educational purposes based on publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of the material. The information presented may change at any time and without notice.
Thank you, Kellen, for getting us started today. And thank you again to everyone for joining us for our third and last virtual quarterly call of 2026. I'm joined by Dominic D'Angelo and Peter O'Keefe. We're just going to be walking us through their thoughts and some market updates, recent trends, as well as just recapping some changes that have been made in the portfolio in the past quarter, including partial sales of Corning and Qualcomm, the complete sale of Roku, and then purchases of Cetera Health and Octave Intelligence. We'll wrap things up in the same fashion as always with a Q&A. So like Kellen said, if you have any questions, you can use that chat or the Q&A feature within this Teams call, and Peter and Dom will address those questions at the very end. So I'll turn things over to Dom to get us started with some updates on the market.
Thank you, Grace. So it's unsurprising, the main thing we have heard about this year is AI, artificial intelligence, and what is occurring on the capital expenditures, IPO, and capital markets activity, specifically surrounding some of the major hyperscalers, Microsoft, Amazon, Google, Meta, of the likes. And so starting off with the big news in June, SpaceX completed the largest IPO in the history of the US markets, raising almost $86 billion at just under $1.8 trillion valuation. And it was the third largest, it was 3x the size that Saudi Aramco raised when it was the largest IPO in 2019. And so this suggests that the IPO market is open for business. If you want to become public, there is capital, there's a demand there for certain equity issuance. And getting into how this relates to our portfolio, market opportunities, it's very interesting to see sort of what's happened over the past year, where companies have gone from transitioning from using their free cash flow to fund the build out of artificial intelligence, mainly data centers, buying GPUs, and now are looking to the capital markets to fund the next leg of the build out. And to give you an example of this, Google, which was perennially a share repurchaser, where they were just buying back shares hand over fist over the past decade, raised about $85 billion of cash through an equity offering that they're doing over a series of tranches. And just this shift from internal free cash flow generation to fund the build out to tapping the equity market is sort of a turning point in the overall AI landscape story. We're seeing other hyperscalers tap the debt market to fund CapEx build out. We've seen, I believe, Meta, Amazon, Microsoft's the only one that hasn't. Just a lot of capital is flowing into just the overall AI build out. As it relates to the IPO market, we've seen recently OpenAI, they filed to potentially come public, which has subsequently been delayed. Anthropic has done the same thing, but in actual potential IPOs, we're seeing SK Hynix, which is on the memory side, which is like the major discussion point on the artificial intelligence build out. They're currently listed on the Korean exchange, which precludes many US-based investors from investing in that sort of market. They're now potentially listing on the US market. Jersey Mike's, Cumberland Farms, Inspire Brands, which owns Dunkin' Donuts, Buffalo Wild Wings, they've all filed to potentially come public. In Discord, which is like a chat feature, chatbot is potentially coming public in 2026 as well. And so not only are we seeing traditional IPOs where they're going from private to public to raise capital, but we're also seeing this basically like public to public investment, where we saw NVIDIA invest capital into Corning, AMD and OpenAI agreeing to like a warrant stock purchase, NVIDIA and Nokia, NVIDIA and Intel, and there's several other examples of just this public funding helping to fund basically another company's build out of AI. And while it's not an exact IPO, it's just like a different type of equity offering. And the question is, when do we usually see this type of activity? And the answer is usually not in some sort of bear market, valuations are cheap. Usually we're seeing IPOs of this size in markets, in industries that are very hot. Some may describe them as like can't miss. So for us, it only reiterates that patience, discipline is critical. We are not going to chase these hot industries, these hot potential IPOs, and instead could present an opportunity that we'll discuss in a couple slides. And I think one of the things that Peter taught me is that when you have bottlenecks or you have a challenge, don't bet against companies finding ways around these bottlenecks. And so today, all we hear about is how memory is going to be in short supply for the next 3, 5, who knows how many years. Well, if this is true, what's like the most logical thing that's going to happen? Either NVIDIA and other hyperscalers are going to find ways to reduce their reliance on memory, or we're going to find some sort of alternative that may give us the same performance as what memory currently has. When something 10x is in price over a year, and now we're seeing companies raise the price of their products, usually that's a sign that we're going to find ways to reduce our reliance on certain parts of the supply chain. Pete, anything to add here?
No, I have nothing to add. Thank you, Dom.
Yep. So the next question is, we don't participate in IPOs, and what is like the rationale behind us not participating in them? So I wanted to provide some data on what the performance of IPOs is typically like. And so there was a study done by Ritter. He's a University of Florida professor, and he went back to 1975 to see what the performance of IPOs is like. And to sort of make it like an apples to apples comparison, he would also compare them to a similar type of company. So for example, if you had a $10 billion tech company come public, what other $10 billion tech company would be of similar valuation, size, of the sorts that you could compare it to? And what we found is that on average, an IPO relative to that similar company underperforms by about 9%. And the question is, why is this? Well, when you're IPOing, the most likely thing you're trying to do is make your valuation the highest it can possibly be, because this is one of the few times you can go out and raise cash for your business. And if you're a insider that is trying to get liquidity for the first time, your objective is to raise the most amount of cash you can personally, because this is your opportunity to take some chips off the table. And so what likely that means is the companies come to market at a very high valuation. That valuation is then not supported by the subsequent year's business performance, and therefore leads to the underperformance of the business and the stock relative to what basically like the IPO expectations were, and relative to what the similar size companies and stocks do in the same market. What we also saw is that the larger companies on average perform around in line with the market, and it's a lot of the smaller maybe unprofitable companies that are the real drag on performance over time. And so again, it only reiterates, if at best you're getting the market return and at worst you're getting significant underperformance, it's best to probably look at elsewhere for your ideas. You're on mute.
Over my career, it's exactly what I've seen, is that IPOs tend to be way overpriced. And given that we invest in the unloved and unwanted, it would make no sense whatsoever for us to be involved in IPOs when they first come out. Once they've dropped off by 60, 70, 80, 90%, and the business has performed up to some of our expectations and has improved, that we could take a different view on it. But when they first come out, almost always they're valued at prices that we won't go anywhere near. And of course, SpaceX is a perfect example of that. Well, it's an extreme case of that, actually. Dom?
Yeah. What was somewhat interesting was the study that I looked at for whatever reason. The first 3 years, the stock underperformed. And then for whatever reason, there was a consistent pattern that the fourth year, the stock would outperform relative to the market or to that comparable stock. Just some sort of anomaly that, who knows, maybe down the line might be something to actually incorporate into our process. But for the near term, we will look at where others are not looking for our bargains. So tying this back to sort of the AI build out, the capital markets activity, and how does this potentially impact what we're doing? So the four largest hyperscalers, think Microsoft, Amazon, Meta, Google, are expected to spend about $725 billion of capital expenditures in 2026. And that's up 77% from last year. And then next year, they're expected to spend over $1 trillion. And we are past the tipping point of they can internally fund this growth. They are now looking to the equity markets, the debt markets to fund this build out. And the chart on the screen shows that from 2024 to an estimated 2026, Google's capital expenditures are nearly quadrupling, just over tripling relative to just a couple of years ago. And so if capital needs to flow from somewhere to fund this build out, because it's no longer just internal free cash flow generation, where are people in companies selling to raise the cash to be able to buy the SpaceX IPO, to buy the Google equity offering, to buy the potential Meta offering? And that's potentially the idea of that, or that's the potential area of where we want to look. It's not where everybody is looking. We are not solely focused on AI and where AI is going. It's the software or potential other industries that people are saying AI is going to kill over the next 5-10 years, where if somebody thinks something is going to be non-existent in 5 to 10 years, and we can do our fundamental research and come to a conclusion that, no, we think software companies or whatever the other company may be have a place in the future, that's more likely the area that we're going to find a bargain. Pete, anything to add?
Yeah, in this on your market update here, you mentioned NVIDIA. The data center revenue was up 92% to $75 billion. Just recently, I read Jensen Huang's letter to shareholders, and I believe it to be a wonderful document that explains some of the incredible potential that's out there with AI. And of course, you know, we were early investors in NVIDIA back in 2013 when it was unloved and unwanted. And so you'll be getting an email shortly that is the newsletter or the shareholders letter. And I highly encourage you to read that. And certainly if you have any questions or comments on it, we'd be happy to discuss them with you. Dominic?
Thanks. So wrapping this all up. So if we take SpaceX, for example, they just came public at a $1.7 trillion valuation. The NASDAQ 100 just gave them an exemption to be included into the index. Normally, there's at least a 3-month period that the company has to wait before they're included. For whatever reason, NASDAQ decided no, SpaceX only needs 15 days until they're allowed to be included in the index. And so if you add a $1.7 trillion company into an index that is fully invested, what has to happen in order for the NASDAQ to be able to buy those shares? And the answer is they either kick out one constituent and then sell a portion of the remaining constituents to be able to raise the cash, or in this case, nobody got kicked out, and instead they're just selling basically a pro rata of the existing companies in the index to fund the 1% purchase of SpaceX. And so when someone is indiscriminately selling a stock, not for any fundamental reason, that could potentially be a source of a unloved or hated stock. One of the ideas that we came up with in the past was Compass Minerals, and it was kicked out of the S&P small cap index. And that resulted in significant forced selling pressure, not because the business was doing terrible or because there were other issues going on, but for no other reason than there's a certain requirement. Compass Minerals did not meet it, therefore we have to sell. And that's similar to what we're seeing today. A lot of funds that I talk to and other analysts are not investing in certain industries because they are afraid of pitching certain ideas to their portfolio managers. And when somebody is afraid to pitch an idea because they think they may look stupid, again, that is the potential opportunity set that we have in front of us. And so while we're not going to take all of the cash that we have set aside today and deploy it tomorrow, opportunistically finding ideas over the next several months, I think is going to be slightly easier than where it's been in the past, because nobody is focused on some of the areas that we are looking in, and instead are solely focused on these 10, 15, 20 companies that all surround artificial intelligence. Pete?
I would just say it looks like a great opportunity for us, and we'll continue to search for things that are unloved and unwanted that we can buy at great prices. But of course, one of the caveats that goes along with that is we're not expecting an immediate return. We're more than happy to own investments for 5 or 10 years until they become loved and wanted again. And you're about to discuss a little bit of our trimming of some of those companies in the next part of your presentation. So go ahead, Dom.
Sounds good. Sounds good. Grace, do you want to introduce what's going on?
Yeah, I also just wanted to thank you both for the explanation and sharing your thoughts on IPOs, in particular the SpaceX IPO. We've had quite a few people ask about SpaceX or just about IPOs in general and what we think about participating in those purchases. And it's truly the antithesis of our investment philosophy to invest in something that the market is either not paying attention to or thinks is not attractive, something that's unloved and unwanted, as Peter just said. And you have literal road shows for IPOs where you essentially just have people hyping up the company and the ability to buy into this company for months before it launches. So it's a thing that a lot of people get attracted to because of, the fear of missing out. But I think your explanation has just shown exactly why we do not partake in those. On the portfolio changes, Dom and Peter are going to be explaining our thoughts behind the sales of Corning and Qualcomm, and also explaining the structure of the sales. I know there's been some questions about that as well. So I'll turn it back over to you, Dom.
So during the quarter, we did a partial sale of Corning and Qualcomm. And the rationale behind it is both stocks had appreciated near what we think they may be worth and are potentially caught up again in the overall excitement of artificial intelligence. And we structured the sale. If you have options on your account, we would have sold a certain number of options that would hedge a portion of your position. And if you did not have options, we would have sold a portion of your position. The reason we did options is because it allows us to defer taxes while generating near-term cash, and it also hedges the downside should the stocks decline. And I'll go into more detail on the exact structure on the next slide. So we sold the 185 calls on Qualcomm and the 180 calls on Corning. We sold these for $45 and $54 respectively. And what this does is for every option's worth 100 shares. So we collected the premium of roughly $4,500 on Qualcomm and about $5,400 on Corning. If the stock stays below $185 for Qualcomm and $180 for Corning, what will happen is basically nothing other than you keep your shares and you keep the premium that we sold it for. So you would keep the $44.80 and the $54 per share of Qualcomm and Corning. If the stock is above 185 or 180 for Corning, what would happen is you keep the premium, but your 100 shares per option sold would get sold at those respective strike prices. So for Qualcomm, if the stock is above $185 on January 15th, 2027, you've agreed to sell your Qualcomm shares for $185, and for Corning, same date, but for $180 per share. Again, this just hedges our potential downside, allows us to generate cash near term, and the main thing is since the stock would get called away or sold in January of 2027, you would not pay the taxes from the gains until next year. And given what we've already done this year, we thought it was a prudent thing to try and space out the gains until next year. Pete, anything to add?
Sure. Both Qualcomm and Corning are very, very long-term holdings, have appreciated significantly, and especially in the case of Corning, that rose to $113 per share in the year 2000, only to decline a few years later to $1.50. And we had a similar run up in Qualcomm in the year 2000 as well, or year 1999 into the year 2000. And naturally, as stewards of your wealth, we felt it was appropriate to take some money off the table, and we're happy to have that opportunity to further diversify the portfolio into things that are unloved and unwanted. But clearly, right now, Qualcomm and Corning are loved and wanted, and we still continue to have significant positions in them nonetheless. So we certainly hope that they continue to benefit from the AI development as well.
Yeah. One of the things I said to Peter coming into the year was the thing that would concern me the most is if we started to see a capacity expansion specifically by Corning. And earlier this year, that's exactly what they announced with their North Carolina facility. They're mitigating the potential risk and downside by having NVIDIA help fund the build out. But the capacity expansion is exactly what led them into troubles in 1999, 2000. And so again, it is just a prudent thing to do when the potential risk of the company is increasing. Stock has done really well. Just take some chips off the table. So what did we do with some of the proceeds and just the cash on the sidelines that we have? We initiated a new position in Sotera Health. It's a healthcare company that specializes in the sterilization of basically medical equipment. So if you think of a catheter or basically anything that goes into a hospital, PPE equipment, they have to get sterilized first before entering any medical facility to basically ensure that it's clean. And Sotera Health, basically their process is it goes into an ethyl oxide, basically like gas chamber, and it just sterilizes any products that it comes in contact with. And so I have followed this company for about 4 years and finally made an investment in it. And the reason we were waiting so long is I've known this is a great company for the entire time. It's basically a duopoly with Steris. And the issue was private equity owned about 80% of Sotera Health when they came public and had basically been selling down a portion of their stake over the past 4 years. And something we've seen previously, whether it's AirCap, Bank of Ireland, is that when there is a large shareholder selling down their stock into the open market, typically presents a lid on the stock, because anytime the stock appreciates, they're just going to be in the market selling their shares, and that'll just then subsequently reduce the stock price. So private equity is now done selling. And the other issue is that there's ongoing litigation where basically there are concerns that the gas that Sotera uses to sterilize the equipment has been leaking outside of their facilities and is potentially causing harm to neighboring towns and cities. If you ever listen to the management team and basically do the research on what the litigation says, basically, if you're around the facility, you're fine. The air is almost cleaner than where if you were to go like 10, 15 miles to some nearby city. The litigation is basically if you stood next to a Sotera Health sterilization facility for 75 years, 24 hours a day, 7 days a week, are you potentially at higher risk of developing cancer? And the answer is maybe, but it's just like an unrealistic type of setup because that is not something that would really ever be done. But that's sort of where they're in the courts today. And we would expect them to resolve any sort of outstanding litigation by the end of next year. I believe right now they have California is the main one that they're working through. And so the litigation and now the private equity holder is gone. We expect the litigation to end in the near term. And so now we're left with like a duopoly company that is going to grow revenues anywhere from 5 to 7%. We expect them to grow earnings almost double digits per year. And we're buying it for about 15 times earnings. Given that setup, they're able to use their free cash flow that they have to pay down debt, which will just be more accretive for equity shareholders. And along the lines, there's been potential activist campaigns that want them to sell off a portion of their business. And if that happens, then you can see an even larger debt reduction in the near term. So we think we're paying 15 times earnings for a growing, high quality, recession resistant, whether you're in good times or bad times, you're not going to delay a medical practice or a medical procedure because of what the economy is doing. If you need a procedure, you're going to do it. So we have a recession resistant, high quality, good business trading at a quality valuation. In the opportunity portfolio, we owned a company called Roku. They're the streaming company or streaming stick company. You may also have their TV. On June 15th, 2026, Fox announced that they are acquiring Roku for $160 in cash and stock. I believe $95 of cash and 0.96 shares of Fox for every 1 share of Roku owned. And we sold a Roku stake after about a little over 2 year holding period. End result was a solid return. And we sold because I'm aware of Fox, but Fox is a different business than what Roku is. And just the future monetization of Roku's platform with Fox is a different setup than when Roku was just a standalone entity. So for that reason, I thought it made sense to sell Roku. With the proceeds, we purchased Sotera Health. And then we also made a new purchase in Octave Intelligence. Octave is it's a software company that was recently spun off, so separated from a Swedish company called Hexagon AB. Hexagon is a test and measurement business. It's vastly different than what Octave does. And the interesting part was for every 10 shares of Hexagon that you owned, you would only receive 1 share of Octave. So imagine in your portfolio, you had a 10% position in Hexagon. That position would now basically be 9% Hexagon, 1% Octave. And so what that typically results in is just like indiscriminate selling of shares because nobody wants a small position that they don't know much about. It causes forced selling pressure. That forced selling pressure typically results in a lower valuation. And Octave is a very good business. They help on like the manufacturing, design, and construction of think of like utilities, gas plants, where if you're an engineering company, one of the companies is Fluor, they construct basically like natural gas turbine facilities. Fluor is going to hire Octave and buy their software package to help design that facility during construction, should anything need to be changed. Octave's software platform allows them to swap components and understand what the downstream effects of the swap are. So their software package is relatively cheap compared to what the potential negative consequences are of either bringing it in-house or going with some other company. Octave may only charge $1 million or $2 million for their software platform, but the amount of money that they can save Fluor or other customers is multiples of that. And that's a great setup where the replacement of the software is highly unlikely. I think the market broadly sees Octave and by and large software companies as net losers in AI. But if you look at how ingrained Octave is in their customer base, basically nobody gets rid of their software platform. They have like 99% retention in their large customer cohort base, which shows how critical they are to their customers. So we think Octave's a good company. We think there was indiscriminate selling that resulted in an attractive valuation for us to purchase that, and believe the AI fears that the market has around basically all things software is overblown. Brace?
Thanks.
Oh, Kellen, sorry.
Yep. Sorry. Thanks, Dom. Just want to let everyone know that the registration for our annual investor forum is now open. This year, the event is going to be at the Strong National Museum of Play in Rochester, New York. And the event actually starts at 5:30 with food and drinks, and our presentation by the research team will start at 7. So if you'd like to come, please go to the website listed on the screen or email anyone on the team for the registration link, and formal invites will be sent out soon, so keep an eye out for those.
Thank you, Dom and Peter and Kellen, for this great presentation today. If anyone has questions, you can put them in the chat box right now, and we'll stick around for a second and answer them.
We did have one pre-submitted question. So it was about hearing more about Corning in the next investor meeting. I'd love to hear more about Corning at the next investor meeting, was the comment.
Before you go into a dialogue about Corning, I wanted to point out I was in listen only mode today, and there's clearly a theme going on here about unloved and unwanted investments, and we heard about some new opportunities that fall into that category, and Dom talked about why we sold off some Qualcomm and Corning, but maybe take us back to just what exactly was going on with those two businesses when we made those initial purchases, and how those stories that were initially in the unloved and unwanted bargain bin became some of the favorites in the market today.
Sure, I'd be happy to talk about them. Why don't I start with Qualcomm? Qualcomm, one of the last changes by the Obama administration was to start an antitrust suit against Qualcomm for being a monopoly. And shortly thereafter, Apple stopped paying royalties to Qualcomm. Shortly thereafter, Huawei stopped paying royalties. And we're talking about billions of dollars in revenues that suddenly came to a screeching halt. After that, fast forward about a year later, Judge Judy Koh in California made the announcement that not only is Qualcomm a monopoly, their business model is illegal. Quite a punch to the gut. The higher court said that was incorrect. If you don't have to use their chips, but if you use chips at all to communicate cellular-wise, Qualcomm, you have to purchase the Qualcomm technology chips, and so virtually anyone who's in the cellular market has to pay royalties to Qualcomm. And over time, so the Supreme Court decided not to hear that case, or was decided not to bring it to the Supreme Court, and so that was put behind them. And Qualcomm has continued to make an effort to further diversify their businesses. I was at their investor forum in New York a few years ago, and they have a clear path to further diversifying the business and are doing a strong job already with that. And they just recently had another investor forum last week in New York. I didn't have a chance to attend that, but I'll be listening to the full report on that. But it's more of continuation of their efforts to diversify. In the case of Corning, being in Rochester, New York, we're long familiar with Corning, a company that history goes back 275 years. They have been incredible innovators with very big problems over the years. Everything from the light bulb encasing for Thomas Edison's light bulb, to which is a technology that is still used to this day. In addition to that, the railroads, the little red lights that come flashing on when a railroad train is about to, what happened with those red lights is, if they get very hot, but if it started to rain, the rain would break those, and Corning solved that issue as well. So the fiber optics that is so important now was actually an invention that came about in the early 1970s. But telecommunications companies did not embrace it. They were using copper over fiber optics until they were forced to with the growth of the internet in the 1990s. It got way overvalued in the year 2000 and had a subsequent drop off when a company who gave them $1 billion in orders went bankrupt and was going to build a coast-to-coast fiber network that never happened. Clearly these things were unloved and unwanted at the time. And Justin and I would go into financial reviews, and the number one question we always got was, what's wrong with Corning? What's wrong with Corning? What's wrong with Corning? What's wrong with Corning? And we would say, nothing's wrong with Corning. We believe in their technologies. And yes, you bought the stock at 18, it's now at 12. It's a great opportunity to add to your position, which many of you know we did over and over again. And when the stock started taking off late last year and earlier this year, we decided that it was a prudent thing to do, is to take some money off the table. We view ourselves as stewards of your money, and that's what a responsible steward would do.
Thanks, Peter.
Welcome.
Great.
We do have another question that was submitted by Ed. Yes, is the outlook on Sphere still positive with future plans, any build out they do in other locations?
Yep, I can take that. So the answer is yes. Sphere, what's interesting with Sphere is it was another one of those spin-offs. And given how new the Sphere concept is, there are obviously going to be some growing pains to understand like what the venue technical capabilities are, how to properly show different performances. And they're now at the point where the Sphere in Vegas has basically demonstrated that it's a economic good venue to host different events and basically movies or immersive experiences at. We've got the one in Abu Dhabi that's still going on, one in Washington, DC. There's been rumors of one in Nashville, Tennessee, and I suspect there are several others that are in ongoing discussions. They just came out and announced that they're going to start showing basically a movie, Rocky Horror, sometime in 2027, and that is going to be basically like the late cap, the late night show. So what it's basically going to do is, right now their main shows are either a concert or The Wizard of Oz. And they've got another one that's planning to come out in early 2027 as well right now. But during the day, you may have The Wizard of Oz at like 11 a.m. and 2 p.m. and then a concert at 5 p.m. Or you might have The Wizard of Oz at like noon, 3, and 6, and then that's it for the day. Well, the new show, Rocky Horror, is going to be like a 10:30 and 11 p.m. show, which is basically a whole new slate, 130, 140 potential additional showings at the Sphere that likely has a different audience than what The Wizard of Oz or maybe a certain concert has. So that is going to be all incremental, high margin revenue that the company is going to have. And the better the economics of the Sphere in Las Vegas, the more opportunities they have when they're on the road marketing new concepts or new locations for additional Spheres, the higher the royalty rate they're going to be able to ask for, because they can go back and say, hey, this is what the Sphere generated in Vegas. This is what we think it's going to do in your city. Therefore, instead of a 2 or 3% royalty that maybe they initially started off with, they could maybe go 5, 6, 7, because the concept is such a high margin, generates significant amount of free cash flow. And then I think the kicker in the future is we started with a film that was from like 1935 in The Wizard of Oz. I don't foresee a film that they're going to show could be any more challenging to display on a brand new state-of-the-art screen. So most likely content cost production is going to come down in the future. And if you can get that same sort of allure that The Wizard of Oz had, but get the cost of production down, that's going to drive even higher margins in the future. So we've got lower production costs in the future, more shows. And then on the concert side, I'm not sure if there's been concerts that aren't sold out, but every single residency seems to extend longer and longer, showing the demand for the concert series. So the stock is appreciated significantly, but I still think there's only one Sphere today. There will be 3 Spheres in a couple of years. I don't know what the market size opportunity is, but it's going to be more than 3.
Dom, I also was, there was an agreement signed in Japan as well. To build a Sphere.
Interesting. Okay.
Tom, I had one follow-up question on Sphere. We talked about ticket sales, but the advertising dollars for advertising on the exterior of the Sphere is a big part of the story here and a huge revenue line item. Has Sphere mentioned anything about the smaller Spheres in the other locations in terms of what advertising expectation, like advertising revenue expectation, will be at those locations?
Yeah, they have not. I think the main focus right now is what they generate inside the Sphere. For Vegas, they disclose that like during the Consumer Electronics Show, during like your main marquee events that occur out there, the Sphere has no trouble selling out the advertising space. The way they currently do it is 50% of time is allocated to some sort of like just fun, like show attraction, just whatever, and not advertising. And then the other 50% is allocated to potential advertisers. Right now, they are not selling out that 50% during periods of like slower, just like off cycle time. So I think the main revenue driver, main earnings driver today is the inside ticket sales. The opportunity for them is, can they start improving the advertising on the exterior, the exosphere of it. They're also doing like partnerships. Like I think they have JetBlue and like different suites are getting sponsored. Is that a potential revenue driver in the future?
Got it. Thank you.
Yep.
I don't think we had any more questions submitted, so Calvin, if you want to go to our next slide.
Do you mind hitting next slide? Thanks. Well, this is going to do it for our quarterly call. Just as a reminder, you can always send in questions you'd like answered to our team over email before the call, and you can email them to any member of our team. We'll get them addressed in this call, but thank you all for listening, and you'll be able to see the recording live on YouTube and our website within the next 24 hours. So thanks for your time, guys. Have a good rest of your day.
Thank you,
Thanks.
everyone.
Thank
We'll
you.
see you in
Thanks,
October.
everyone.